Welcome back to Gold Rush Reporter, your go-to channel for clear, actionable gold and silver analysis. I'm your analyst, and today we're talking about a critical timing opportunity in precious metals that many investors are about to miss. Here's the situation. This Monday is Martin Luther King Day, meaning US markets are closed. But global futures markets remain active. That creates a liquidity gap, a period where trading is thin and volatility spikes. In plain language, prices can move fast and hard, while most traders are waiting for Tuesday to act. Why does this matter? Because you don't want to wait. History shows that during these kinds of gaps, precious metals often experience sharp upward moves, sometimes before regular markets even open. Analysts, including Peter Schiff, are warning of another weekend rally starting Sunday night, with momentum continuing through Monday and into Tuesday. For gold and silver investors, this is a make or break moment. Waiting for standard trading hours could mean buying at significantly higher prices after the herd has reacted. By moving early, you position yourself ahead of the crowd, potentially capturing gains before prices are repriced. Now, let's break down what we're seeing in the markets. Gold is trading at $4,600 per ounce, silver at around $90 per ounce. These are historically high levels, yet volatility continues. Some traders might hope for a pullback to buy cheaper, $50 silver, for example. But that window has long passed. Even if silver dips slightly, physical supplies are limited, and premiums on coins and bars are rising fast. That means the price of physical silver could continue climbing regardless of spot price movements. Let's be honest, waiting for a perfect entry is no longer realistic. Premiums for physical coins and bars are about to surge because demand is outstripping supply, especially with the holiday pause in US trading. This creates an unusual but predictable market dynamic, a gap-driven move. If you act before the US markets open on Tuesday, you are likely to enter at lower premiums than those who wait. Silver has been far more volatile than gold recently. But this is not random. It's a consolidation at historically high levels following a major breakout. In other words, the metal is digesting gains, but the upward trend remains intact. The previous week's rally shows that weekend positioning can capture almost the entire move, especially if you buy in futures or through global dealers who remain active during US market closures. Now, before we dive deeper into the factors driving this rally, here's an important point. Timing is everything. Waiting until Tuesday means you are following, not leading. The smartest traders position themselves before the crowd reacts, not after. That's how you protect capital, maximize gains, and avoid being caught paying inflated premiums. Finally, a quick reminder. Subscribe to Gold Rush Reporter and activate notifications. The markets are moving faster than ever, and you want to know immediately when gold and silver present key opportunities. Now that we've set the stage with timing, let's dig into why gold and silver are moving so aggressively, and why Wall Street seems completely blind to it. First, let's talk inflation. The official numbers may look reasonable on the surface, but the truth is far more alarming. Recent Consumer Price Index, CPI, data shows prices rising faster than most people realize, and the Producer Price Index, PPI, which is even more forward-looking, confirms that inflation is accelerating. Why does this matter? The PPI measures costs at the wholesale level, the prices producers pay before goods reach consumers. When PPI rises, it signals that consumer prices will follow, often more sharply. Recent PPI data showed a 3% year-over-year increase, higher than analysts expected. Even the core metrics, excluding food and energy, jumped to 3.5%, signaling sustained pressure across multiple sectors. Meanwhile, the Federal Reserve is talking about cutting rates, despite inflation running well above their 2% target. Normally, you would expect rate hikes to cool prices, but the Fed is behind the curve. That disconnect is extremely bearish for the US dollar. And when the dollar weakens, gold and silver typically spike because they are priced in dollars and serve as a hedge against inflation and currency risk. This is where the Martin Luther King Day holiday creates a unique window of opportunity. US markets are closed, but global trading continues. Prices can react to these inflation realities before the broader public and institutional traders are back online. Historically, this kind of pre-market, low liquidity movement leads to rapid spikes, exactly the kind of setup we're seeing this weekend. Another factor driving precious metals is fundamental economic weakness, despite what mainstream media reports. Look at the trade deficit. It recently appeared to improve, but the main driver wasn't manufacturing or exports. It was a massive outflow of gold. The US exported gold, which temporarily reduced the trade deficit, but this is not a sign of economic strength. It's a warning that the dollar is losing purchasing power and that the US government is relying on asset flows rather than real production to balance the books. Combine this with the fact that global interest in gold and silver remains high, and you see why physical supplies are tightening. Coins, bars, and collectible bullion are moving off shelves fast. Even if spot silver dips slightly, premiums on physical products may continue to rise because supply is constrained. This is why waiting for a better price could backfire. You may get a lower spot price, but pay higher premiums, erasing any benefit. Let's also consider the geopolitical and policy backdrop. Actions by government leaders, trade policies, and unexpected events, including legal and political turmoil, are pushing investors towards safe haven assets. Gold and silver benefit first in these environments because they hold value when confidence in government and currency erodes. Peter Schiff and other analysts often compare this to early warning signals, much like subprime mortgages foreshadowed the 2008 financial crisis. Gold and silver react first. The dollar and treasury markets lag. The takeaway is simple. High prices, volatility, and thin holiday liquidity combine to create a rare opportunity. Investors who act during this weekend window could secure positions before the herd jumps in on Tuesday, when premiums and demand spike. Timing is everything, and this is not just theory. It's historical behavior repeating itself under similar conditions. Now let's focus on silver, because right now it is behaving very differently from gold. And that difference is crucial for anyone looking to protect wealth or make strategic buys. First, silver is much more volatile than gold. Over the past week, we've seen swings of several dollars in a single day, while gold has moved more steadily. Volatility at these levels is not random. It's a reflection of both high demand and tight supply. Unlike gold, silver is heavily used in industrial applications, collectibles, and bullion stacking, which puts additional pressure on the physical market. The window to buy silver at historically low premiums is effectively closed. Think about this. $50 silver is no longer available, and even $70 silver is a stretch. Most bullion dealers are running low, and premiums on coins and bars are expanding rapidly. Even if spot prices were to dip slightly, the cost of physical silver might continue to rise due to limited availability. That's why waiting for a pullback is often a mistake. You could end up paying more in total than if you had bought now. Supplies are a critical part of this story. Many US and global mints are experiencing production and shipping bottlenecks. Popular silver coins, whether American silver eagles, liberties, or collectible medals, are moving off shelves quickly. As premiums rise, early buyers capture lower cost entry, while late buyers face inflated prices. This is exactly what we're seeing with the Martin Luther King Day holiday gap. US trading is paused, but global demand continues. Prices can spike before the broader market even opens on Tuesday. Another factor is forward-looking inflation and economic uncertainty. Unlike gold, silver reacts to both investment demand and industrial trends. Inflation pressures, particularly from rising producer prices, signal that the cost of goods and raw materials will continue to climb. Silver, being both a hedge and an industrial metal, is uniquely positioned to absorb this pressure. Investors who act early can secure physical silver at more favorable pricing before premiums inflate further. Now consider the psychological element. Many investors still rely on Wall Street narratives, assuming a strong US economy and stable dollar. But these signals are misleading. Gold at $4,600 and silver at $90 contradict claims of economic stability. Recent trade deficit improvements were largely due to gold exports, not manufacturing growth, meaning the dollar is losing purchasing power even as official data appears positive. This makes silver, in particular, an early warning asset. Its price action often foreshadows broader systemic issues, just like gold did before past financial crises. When Wall Street ignores this, it creates opportunities for savvy investors to buy ahead of the herd, capturing gains before panic buying drives premiums even higher. Physical silver also behaves differently from paper contracts. While futures and ETFs can provide exposure, they do not guarantee access to tangible ounces, especially during periods of high volatility. When premiums spike due to scarcity, having actual silver coins or bars becomes more valuable than any derivative exposure. This is why stackers and collectors alike are prioritizing physical holdings now, even at elevated spot prices. To summarize, volatility is high. Silver is moving faster than gold. Premiums are rising. Physical coins and bars are becoming scarce. Supply constraints, US and global mints, cannot keep up with surging demand. Inflation pressure, both consumer and producer price indices signal rising costs. Physical advantage, owning tangible silver protects against both currency weakness and market speculation. The lesson is clear. Silver is not waiting for Monday or Tuesday. Its window for strategic early action is happening right now. Buyers who hesitate risk paying higher premiums and missing the initial surge triggered by the holiday liquidity gap. Now that we've covered timing and silver volatility, it's critical to understand the macro and political forces behind these moves. Because without that perspective, buying gold or silver now is just speculation, not informed strategy. First, let's talk about the US economy and dollar weakness. On the surface, reports claim the economy is stable, inflation is under control, and deficits are improving. But a closer look reveals the truth. These indicators are misleading. For example, the recent improvement in the trade deficit was driven primarily by gold exports, not a boom in manufacturing. In other words, the US exported a large amount of gold, which temporarily made statistics look better. This is not economic strength. It's a warning signal. The dollar is under pressure. Despite high inflation and rising prices for gold and silver, the Federal Reserve is considering rate cuts. Normally, you would expect rate hikes to slow inflation and stabilize the dollar. Instead, the Fed is behind the curve. This policy error is extremely bullish for precious metals and bearish for the US dollar and bonds. A weaker dollar increases the buying power of gold and silver internationally, which adds upward pressure to prices. Now consider the political landscape. Government actions, including trade policies, fiscal mismanagement, and unexpected legal events, are creating uncertainty. Recent news regarding investigations into Federal Reserve actions and policy decisions is shaking investor confidence. When confidence in the dollar and government solvency declines, gold and silver act as early warning signals, just as they did before the 2008 financial crisis. Peter Schiff compares the current situation to the subprime mortgage warning in 2007. At that time, early signals appeared in a small sector of the market, while the broader public was oblivious. Similarly, gold and silver are flashing alerts about a potential sovereign debt crisis in the US. The difference now is that the crisis won't be triggered by mortgages. It will come from government debt and dollar instability. This makes the timing of purchases critical. Investors who act early can position themselves ahead of large-scale panic buying, which could drive prices even higher. Let's also examine inflation data. Consumer Price Index, CPI numbers have risen modestly, but the Producer Price Index, PPI, tells a harsher story. PPI measures costs at the wholesale level, which are forward-looking indicators of consumer inflation. Recent PPI numbers show 3% to 3.5% year-over-year increases, significantly above the Fed's 2% target. This means price pressures are not slowing, they are accelerating. Physical silver and gold are the natural hedges against these pressures, especially when the government's monetary policy continues to lag reality. Another factor is the liquidity gap over the holiday. With US markets closed on Martin Luther King Day, global trading activity will dominate pricing. Historically, such periods create rapid upward moves in precious metals, as global buyers react faster than US-based investors who wait for Tuesday. This gap makes it an ideal moment to buy before premiums spike and the crowd reacts. Finally, geopolitical risks amplify these dynamics. Uncertain policies, trade disputes, and unexpected political actions, from executive decisions to international tensions, are pushing investors towards safe haven assets. Gold and silver benefit first in these environments because they retain value when confidence in government and currency erodes. To summarize Part 4, dollar weakness and Fed missteps are pushing gold and silver higher. Political and economic instability increases demand for safe haven assets. Producer prices signal accelerating inflation, reinforcing metals as hedges. Holiday liquidity gaps create unique opportunities for early buyers. Geopolitical and policy risks amplify uncertainty and metal demand. Now let's bring it all together and focus on practical strategies for investors looking to navigate this weekend gold and silver rally. This is where knowledge meets action, because understanding the market without acting is lost opportunity. The first and most important principle is timing. As we discussed, this weekend presents a rare liquidity gap. US markets are closed for Martin Luther King Day, but global markets are still active. This means gold and silver can move significantly before the broader public even has a chance to react. Acting now, before the herd jumps in on Tuesday, can save you from paying inflated premiums. For gold buyers, the situation is straightforward. Prices at $4,600 per ounce reflect both market volatility and dollar weakness. This is not a speculative spike. It is a signal that the US dollar is under pressure and government debt is rising. By buying now, investors position themselves ahead of the crowd and secure an early hedge against potential dollar depreciation. Silver requires even more attention. Unlike gold, silver is more volatile, more affected by industrial demand, and more sensitive to supply shortages. Premiums on coins and bars are already expanding. Even if spot prices dip slightly, the total cost of physical silver may continue to rise due to scarcity. This makes early positioning critical, especially for stackers who want tangible assets rather than paper exposure. Next, consider the economic backdrop. Inflation is rising faster than the Fed acknowledges. Producer prices are climbing. The core PPI is up 3.5%, and CPI continues to run above target. At the same time, the Fed is considering rate cuts, a policy mistake that further pressures the dollar. Holding gold and silver now is effectively buying insurance against an economic system that is eroding purchasing power. Investors should also separate short-term speculation from long-term strategy. Buying this weekend isn't just about chasing a spike. It's about securing physical metal before premiums increase further. That means focusing on physical holdings over paper products, coins, bars, and collectible bullion. ETFs or futures may track the market, but they do not guarantee physical access when demand spikes. Selective buying. Prioritize metals that combine both liquidity and scarcity. High-demand coins or well-known bullion products often maintain value better during periods of extreme volatility. Hedging against inflation. This is not just gold and silver for profits. It is wealth protection. Every dollar in the bank loses value during inflation. Physical metal preserves it. Another consideration is geopolitical and policy risk. Current government actions, trade uncertainties, and political turbulence are pushing investors towards safe haven assets. Gold and silver respond quickly to these pressures, often weeks or months before the broader market reacts. In other words, early buyers gain an edge. Finally, discipline is key. Avoid panic buying after prices spike. The smartest investors buy ahead of the rush, based on data and market signals, not emotion. Waiting for a perfect pullback is often counterproductive, because physical supply may be limited, and premiums can rise faster than spot prices move. To summarize, here's your action plan for this weekend. Act now, before US markets reopen on Tuesday. Prioritize physical metal, coins, bars, or collectible bullion. Focus on scarcity and liquidity. Choose products likely to retain value. Understand the macro context. Inflation, dollar weakness, and Fed policy drive precious metals more than short-term stock trends. Maintain discipline. Buy strategically, not emotionally. The key takeaway: gold and silver are flashing early warning signals of economic stress, potential dollar weakness, and rising inflation. By acting now, you position yourself ahead of the crowd, protect your wealth, and potentially gain from the market reaction over the coming days. That's it for this weekend's market wrap. If you found this analysis useful, make sure to subscribe to Gold Rush Reporter, hit the bell for notifications, and share your thoughts in the comments. The market is moving fast, and information is your real edge. See you in the next video, where we'll continue tracking gold and silver trends and uncover the opportunities you don't want to miss.